Welcome to this Killik Explains Finance video. This week, part one of what is clearly going to be a mini-series, First Time Property Buying Basics. So this is aimed very much at first-time property buyers. I'm going to do a quick tour of some of the key decisions and some of the key jargon, but not all at once, as part one suggests. So what are we going to cover here? Well, first of all, renting versus buying. So what are the factors you need to weigh up when you decide to step onto the property ladder for the first time? And it's not clear cut. There's nothing wrong with renting, but there are definite pros and cons. So I can't tell you which route is right for you, but do weigh them up carefully before committing to buying a property. So renting first of all. One downside, you don't own or control the property. So you can't make as many changes as you would, for example, if you owned it. You'll be restricted. You've got a landlord who will be keeping an eye on you, for example. You've got a contract with them. But you bear none of the ownership risk either. So if things go wrong, if you get subsidence or if prices fall, that's not your problem. All right, you won't benefit if prices rise. Obviously, that cuts both ways. You only have to fund a deposit and monthly payments. You haven't got to scramble around to get a full deposit together if you're buying, plus worry about all the fees that come with it. And yes, the deposit might be slightly more than a month, but nonetheless, it's normally transportable and refundable when you rent, provided you don't break the place to pieces in the meantime. And you don't own a relatively liquid asset. People sometimes think, well, buying, I'm putting money down for me. Yes, but property can be fairly illiquid, and at the moment, that's certainly the case in some parts of the country. So buying, it's down to you ultimately. You will own the roof over your own head. You can extend it, redecorate it, refurbish it as you see fit. It's yours. To the extent that you've got a mortgage, it isn't, of course, but we'll come back to that in a moment. It's fundamentally yours eventually. You'll benefit from gearing if prices rise, if they rise, and we'll cover that more in part two of this series. But property can be illiquid, time-consuming and costly. You are responsible for rates, bills, repairs and maintenance, and all that kind of stuff, plus the fees that come with buying a property up front. More about that in part two. All right, and in most cases, unless you're incredibly fortunate, you'll probably need a mortgage. So we're not going to try and do everything in part one. Let's go to mortgages next. So mortgage fundamentals, and this is the bare basics. So what is a mortgage first of all? It's a loan secured on a property. It's just a flash way of saying a loan secured on a property. Now, this is quite scary in the sense that it's often the biggest financial commitment many young people in particular will ever make. It can be a large amount of money, but I suppose the flip side is because it's secured on the property, and that means that technically the lender can seize the property and sell it if you don't keep up with repayments in some cases, something they warn you about. It tends to carry quite a low rate of interest, certainly compared to, say, a credit card loan or some other form of personal loan. So it's a big amount of money, but at a relatively competitive rate, and they come in different styles and flavours, and we'll take a look at that in just a moment. So, main types. There are two basic styles of mortgage, one much more common than the other these days. Repayment mortgages are usually what first-time buyers are offered. Because interest-only mortgages do exist, for other borrowers, we'll cover them briefly, but frankly, as a first-time buyer, you'll be lucky to get one these days. The interest may be fixed or variable, so the rate of interest you pay can come in two different flavours too, and then variable rates also come in two flavours. So the variable rate of interest on a loan, as it suggests, will move around, but move around according to what? Typically either the Bank of England rate, it might track that for example, or it could be related to the lender's own standard variable rate, and that's a variable rate set by them or with or without a discount, depending on the deal you've struck. So, repayment versus interest only. Let's go back to the basic style of mortgage first of all. Now on the left, this is much more likely to be the space you occupy as a first-time buyer. You commit to make regular payments that will clear the outstanding debt over an agreed term. Now that agreed term is typically 25 years, but it could be lower if you can afford the higher repayments. It could be 20 years, 15, or even in some cases I've seen 10. All right. As you shorten the period, obviously the repayments go up. And remember, here, every month you're repaying some capital and some interest, however the interest is calculated. So it's important to bear in mind that in the early years of a repayment mortgage, you'll be paying loads of interest and a little bit of capital every month. And in the later years, let's say the last 5 of a 25-year deal, you'll be paying a lot of capital and not much interest. Why am I telling you that? If you bail out of a mortgage early, you may have an unpleasant surprise in terms of how much capital is still left to go. Okay? Bear that in mind. Now, the lender reserves the right to seize the property if you don't make repayments, but there are some deals around, if you've got variable income, for example, that allow for overpayments, taking breaks, and even making lump sum withdrawals in some cases. So very important to read the small print and think about what will work for you. Now, interest only, less common, so not going to spend a lot of time on it. Here, the borrower only pays the lender the interest on the loan, so the capital's got to be funded some other way. And usually, that other way will involve some sort of investment-based solution, for example, but it could be that the capital comes from anywhere. But you've got to be able to convince the lender you have a way to repay the capital, and that's more difficult to do as a first-time buyer, I have to say. Monthly payments will tend to be lower because you're only paying interest, not interest in capital. And as I mentioned before, they're harder to get unless you've got a decent dollop of equity, or you can put a lot of cash down, all right, and or you can demonstrate other sources of wealth. So, fixed versus variable interest. So I said, basically, let's say you're taking a repayment mortgage, the interest could be calculated a couple of ways, and that's true. So fixed does what it says on the tin. Essentially, the lender agrees a fixed rate with you over a term that you agree. Could be 2 years, could be 5 years, those are fairly typical, all right? They're useful for people who want predictability. So if you like certainty, you've got a salary coming in every month, you want to know how much is going out, repaying your mortgage, well, this will give you that. And it may be slightly higher than you could get if you took a variable deal. So the reason for that is you are getting the certainty. So in an environment where interest rates might rise, and that's the one we're looking at the moment when this is being shot, so July 2018, you'll tend to find that the fixed rate is at a bit higher than the equivalent variable rate. And do watch out. Watch out with any of these deals where it's 2 years, for example, or 5 years, because at the end, you'll be kicked out of what could be quite an attractive interest rate and maybe into the lender's standard variable rate, and they can be quite a bit higher. So get your ducks lined up once these deals come to an end. Now variable does what it says on the tin again. So here, the interest rate and therefore the level of your prepayments is going to move a bit depending on what happens to another rate. It could be the Bank of England's rate, it could be the lender's SVR, as it's called. Usually this is for an agreed period, although there are lifetime deals around for some borrowers, and the rate is typically a bit lower than the equivalent fixed rate deal on the outset, if you like, because the lender might be anticipating that essentially rates will rise and start to pull the amount you pay them up with it. And again, watch out. If you've agreed a variable rate, maybe with a discount, so a discount is where they say, well, actually, as you're a first-time buyer, we'll take the percentage down a bit from, say, 4 to 2. All right, we'll discount for a period. Watch out when you get to the end of that discount period, you'll need to be on your toes to negotiate a new deal, potentially. Now, finally, a word about offset mortgages, just to finish part one. This works for some people as a style of mortgage, and essentially the deal here is, imagine that the loan is £150,000, the mortgage, all right, and you've got savings of £50,000. Now, in a standard mortgage arrangement, you would agree a rate of interest you'll pay on that, and then separately, you'll try and earn a rate of interest on that. But some people look at this and think, well, I can't earn much on my savings, especially in cash, so could I reach a deal whereby we set the two off and I pay mortgage interest, which will tend to be the higher rate, by the way, on a lower amount? So here, very simple terms, you might be able to pay interest on £100,000. All right, so you're getting nothing on your savings indirectly, but you're getting a concession in terms of a lower amount for calculating your mortgage interest. And that can suit people who've got a decent amount in savings and are wondering how to make it work for them. Okay, in part two, we're going to consider some property buying jargon. But for now, any questions, editor@killik.com, and to watch related videos, killik.com/learn.